Welcome to Investors Guide. You're watching ET Now. Thank you so much for joining us. On this show, we try and help with anything that has to do with your money, whether it's spending, saving or investing, with a special careful look at debt. Now, if you have any questions to do with your money, feel free to write to us on the email ID that's at the bottom of your screen. We'll try and answer as many of your questions as possible. Of course, I'm not shy of saying we're a little partial to women investors and especially young people who've just started working. So send in your question or send in a question on behalf of a family member if you like. Over the next half hour, we'll help a young investor plan out his portfolio for himself and his children. In our product review, we look at the UTI balanced fund. And if you only have a salary of 20,000 rupees but a credit card debt of 90,000 rupees, what should you do? We'll find out later on the show. All right, let me bring in Dhirendra Kumar, the CEO of Value Research and our in-house mutual fund expert. Dhirendra, thank you so much for joining us. It's always a pleasure to have you here on Investors Guide. Let's go straight to our portfolio question. Well, Devesh Agarwal has written in. He tells us he wants to create a corpus of 70 lakh rupees for his daughter's future with a time horizon of about 20 years. He has a small baby daughter he's looking out for right now. And he also wants to create a retirement corpus of 2 crore rupees over 25 years. Right now, he has about 1 lakh rupees, in cash in his bank account. He has 4 insurance policies, 2 from LIC, which are endowment policies, 1 from Tata AIG, and he wants to know if he should surrender these policies because right now he has no health cover and no term cover. So first and foremost, obviously, Dhirendra, the first thing that he's going to need to do is take cognizance of all of these insurance policies and find out whether or not he should continue them. How would you like him to do that?
No, there are very simple 2 steps. One is that, most Indian consumers have accumulated insurance plans like this only. So one has to take a very close, harsh look at what you are giving, what you will get. And surely, most likely, it will be prudent to, surrender these. But before that, do a very liberal, given your, stage of life, you should have a liberal estimation of, term cover required, insurance covered, actually needed. And, do it in a liberal way. Don't try and ration that estimate. And go for a term cover. You have age on your side, so it won't be very expensive. And after that, plan your exit. It doesn't make sense to be, getting out of ULIPs or endowment plans in a huff, because you have already, it may not be the wisest investment, but getting out in a hurry might prove to be more, injurious.
Okay, so the most important thing for you to consider right now is to make sure that you have health insurance for your entire family, including your wife and your daughter, and of course a term insurance policy for you as a single earning member. Dhirendra, he has 1 lakh rupees, which is spare cash, in his bank account right now. That can obviously function as some sort of an emergency fund. Should he put it in a fixed deposit, or would you like him to put it in a debt mutual fund? What should he do with that money?
No, I think it makes sense to have that fixed deposit. And also, the return that you get on a savings deposit, on your first deposit, which up to 10,000 rupees tax-free. So it might just be very useful to have that money handy, which is accessible anytime.
And let's talk about his mutual funds, Dhirendra. Given the goals that he has, which are 20, 25 years away, now extra money that's going to come out of these insurance policies, if he does decide to break them, he sent us a list of the funds he's investing in. He has Reliance Banking Fund, which he's marked as a 12-month emergency plan. He has HDFC Top 200, which is also marked as his emergency plan. And other than that, there's the DSP BlackRock Top 100, L&T Equity, IDFC Premier Equity, the Nifty Bees, which is a running SIP, ICICI Prudential Focus Blue Chip, and the Franklin India Blue Chip Fund. Now, first of all, obviously, the Reliance Banking Fund and HDFC Top 200 should not be emergency funds. But given the entire list that he has, would you rather just recommend he looks at one of our portfolios, or can you streamline it for him for the next 20 years?
No, I can streamline it for him, but the point is that, if he is able to just map his portfolio, if he just gets after, if he replicates our aggressive growth portfolio, he will do well. He will come across different phase of the market, and different part of the market will do well. So he should be in a fund which can invest all over, or which can invest anywhere. And from that standpoint, if he is able to replicate our aggressive growth portfolio without the fixed income allocation, our aggressive growth portfolio has 5 funds. And if you drop the fixed income fund, where we have 10% allocation, given that he will have a provident fund contribution, which will be entirely going into fixed income, and he has the emergency fund. So if he's just mapping his portfolio to those 4 funds, that should be good enough. Maybe if he wants to add one more, he should consider substituting that fixed income fund with an international fund.
All right, so the selection of international funds that Dhirendra has recommended for this year are on your screen right now. You've got all of the advice you need to move your portfolio forward. You start with health insurance, with a term insurance cover that's 10 times your annual income. Increase that as your income increases as well. And then Dhirendra is saying focus on the goals, and especially if you have a really long-term goal, it's important to spread your money across the market. Write back to us if you need any more help. Let's take another question. Kalyan has written in, Dhirendra, he wants to invest 4 lakh rupees with a time horizon of 3 to 5 years. Now, he wants to know if he should invest in a bank fixed deposit or if he puts the money in a mutual fund. Is there some sort of guarantee that he'll make at least above 10%? Because if the bank deposit is giving him 9%, he expects a mutual fund to give him more than that. What's your response to someone who expects at least 10% from a mutual fund over the next 5 years?
10% in from a mutual fund and in a 5-year time frame is not a very unreasonable expectation. But it entirely depends that how negotiable is the goal. Can that 5-year, be 6-year? Can that 5-year, or will he be in deep trouble if he is not able to achieve that 10% and that return turns out to be 8.5%? If it is any such frozen goal and a non-negotiable thing, and he cannot take chances with that money, then he is better off with a mutual, with a fixed deposit or a fixed maturity plan, which is unlikely to give him more than 10%, because today the rates are high. Of course, the difference between the return from a FMP is that the return will be virtually tax-free, whereas the return derived from the fixed deposit will be taxable depending on his tax bracket. He can do, he will have marginal benefit if he's able to derive this in a risk-averse way. And if he's, willing to take chances, then I would say that, he should consider investing 10 to 20% of his money into a fixed, into a balanced fund, remaining 80% into fixed maturity plans. Next 5 years, that is his time frame. He's unlikely to be disappointed, and anyway, he's taking a very measured risk with this strategy.
All right, so there you have it. If you do want to do better than a fixed income or a fixed deposit, what you have to do is put a little bit of money into equity and have faith in the stock market. And of course, if you're completely averse to that, Dhirendra said a fixed deposit is the best place for you. Write back to us if you have any more questions about that. We have another question, Dhirendra. Abhijit Mukherjee has written in, wants to build a corpus of 1 crore rupees in the next 10 to 12 years. He can save about 10,000 rupees every month. He wants to know where he should put that money. 10,000 rupees every month. He's obviously a new investor, Dhirendra. Where should he be putting that money?
I would like to tell him that, even a 15% return on 10,000 rupee over the next 15 years will not generate a crore. So even, assuming that, one is able to derive 15% return, he will have to save about, equated 38,000 rupees a month to accumulate 1 crore rupee over the next 15 years. Right now, I would say that he should be into our aggressive growth portfolio that has the potential to generate substantial return, and 10-year time is a good enough time period. Important thing is that he doesn't have 10 years. If he's planning his retirement in next 10 years, then maybe 6-7 years he should be accumulating, and last 3-4 years he should be gradually disinvesting a small part of it which he is likely to need for consumption or to generate income. So that is the approach he should follow, and for next 5-6 years, he should be in our aggressive growth portfolio or the growth portfolio.
All right, on your screen right now is our growth portfolio that Dhirendra recommends for you. And of course, you have a long-term horizon. So as your salary increases and the ability to save increases, you should increase that 10,000 rupees as well. Before we go into break, we know a lot of you have taken on home loans, and the recent rise in interest rates again will cause you a certain amount of stress. What happens if you miss an EMI or two? What can you do proactively to make sure the debt doesn't build up? And how should you manage your home loan? We've put together this very quick report. Take a look.
For most salaried people, the joy of owning your own home is dampened with the burden of a 20-year home loan and the responsibility of making EMI payments on time for the next 240 months. Now, imagine this. You have a medical emergency or lose your job. What happens if you cannot make your EMI payments?
Typically, if you miss 3 payments on your EMI, you get categorized as a defaulter. Now, the exact number of payments is also as part listed in the loan agreement. So if you look at the loan agreement you've signed up for, it also explicitly defines what it is, but the typical number is 3.
The most proactive thing you can do is talk to the banks, but also talk to these counseling centers, and there are some excellent not-for-profit counseling centers. There are for-profit counseling centers as well. It is really your choice which ones you want to go to. But if you go to these not-for-profit counseling centers, they help you once they sit with you and understand what the problem is, and they can then help you talk to the bank to work out a satisfactory arrangement.
So what options does a home buyer have?
So one option is there's a certain grace period in which, because someone has suffered a job loss and might not have a job for the next 3 months, wherein the bank could give a window in which you don't need to pay the EMIs and no fine is charged. Option number 2 is that you could look to extend the tenor of your loan and take the EMI down. There are certain provisions under which the RBI allows that to happen, so that your monthly EMI goes down and becomes manageable.
Experts believe that banks are sympathetic, as it is in their interest that you do pay back your loan and do not become a defaulter. So, what happens if you have financial crisis? How willing will banks be to make adjustments?
We are always, in fact, very, very sympathetic for genuine reasons on account of which he is not able to stick up to his repayment schedule. As and when we realize and he has a genuine problem, and we do consider refacing his repayment schedule, we will give a moratorium period for him wherein he need not repay anything, and we can extend the repayment accordingly as per the cash flows that he has.
Do remember, no one rule applies to all defaulters. Each individual case is dealt with on its own merit. A person's age, occupation, future income flow, past credit score, and security are important factors which the banks take in consideration.
As a smart investor, you should always be prepared for such unexpected emergencies. You should have at least 5 to 6 months of expenses, including your EMI payments, set aside in an emergency fund. It will help you tide over the crisis without losing that home you worked so hard to buy.
Alright, if you have any questions about your home loans, feel free to write to us on the email ID at the bottom of your screen. Quick break. On the other side, Dhirendra is going to stay with us. We'll talk about the UTI Balanced Fund. And we'll tell you if you should be investing in that fund right now. Don't go anywhere. Welcome back. You're watching Investors Guide on ET Now. Thank you for staying with us. Dhirendra Kumar is with us as well. It's time for our product review. This week we're looking at the UTI Balanced Fund. Avan is here to give us a quick introduction. Avan.
Thanks for that, Faith. Well, the fund we'll focus on this week is a UTI Balanced Fund. Launched in January 1995, the fund invests up to 74% of its corpus in equity and the rest in debt. Let's look at its track record. The fund has never topped its category, but it's managed to give its investors a stable investment avenue along with regular dividend payouts, especially during periods of volatility in our markets. The fund has managed to match its category average in every year over the last 5 years, except for 2011, when it fell 19% against 15% on the category. But this performance still makes it an average fund. Let's take some numbers to give you a better perspective. If you invested 1,000 rupees in this fund, you would have 9,102 rupees today. So, despite its average performance, should you still park your funds in this portfolio? Our experts are here to give you the answer. With that, it's back to you, Faye.
Alright, Avan, thank you for those numbers. Dhirendra, let's look at UTI Balanced. With a 74% exposure to equity, it is a fairly aggressive balanced fund, but its performance over the last year or so has sort of been in the middle of the category. Are there better options there for us if we're looking at a balanced fund?
There are better options, but I still like this fund. It has been in the middle of the pack. It is not an aggressive fund. The way its equity portfolio is managed, it is always, large cap. It does not load its portfolio with, speculative momentum or, mid and small cap allocations. So on that front, it is a relatively stable fund. And balanced fund should not be looked upon purely from a performance perspective. Balanced fund is bought by an investor, or it is suited for an investor who is looking for stable return. On that count, I think this fund looks reasonably good.
But Dhirendra, last time we reviewed this fund, you gave it 3 stars. It's retained those 3 stars on value research as well. Is that the rating you'd continue to hold for it?
Yeah, I think I would hold that rating. And my sense is that people should be looking at this category, the set of balanced fund, not purely from return, the highest return, the potential to derive the maximum return, but also from a point of view of how bad can it get in a bad weather, which this fund has the potential to withstand very well.
All right, so if you're an investor who doesn't like seeing a lot of volatility in your portfolio, this may just be the fund for you. 3 stars there for the UTI Balanced Fund on Investor's Guide. Let's move on to our hold or sell segment. Arnab Singh has written in, Dhirendra, he lives in Hyderabad with a wife and a 4-year-old daughter. He tells us he's been investing for a fairly long time. He has 19 funds right now. He's made a lot of changes in his portfolio, and he puts about 5,000 rupees in each of these funds through the year. He sent us a list of the funds. Now, it's a really long list of funds, and we're going to try and move through them fairly quickly. Right on top, the Birla Sun Life Frontline Equity.
Yeah, this is an excellent fund, and he should continue investing in this fund. And it's the kind of fund which I was referring in the context of other questions, that one should have a fund which has internal flexibility. And this fund can be in large cap, mid cap, small cap as well.
Well, the same might be said for the ICICI Prudential Dynamic Plan. He also has the Focus Blue Chip Equity Plan, Dhirendra. Between the two of them, would you like him to hold on to Dynamic?
Yes, absolutely. I would say that, ICICI Frontline Blue Chip is an excellent large cap fund, but if one has to choose between these two and from the point of view of his time frame, I think Dynamic should prove to be a very superior choice.
Well, the Mirae Asset Opportunities is the next on his list, Dhirendra. Continue this fund as well?
Yes, this fund is also worth continuing, and this fund has been able to deliver very handsome return in a very difficult phase of the market, and it has relative to other funds in its own category as well.
Among his non-tax saver funds, he also has the Franklin India Feeder US Opportunities Fund. This has been such a massive performer over the last 1 year. Would you recommend he continues that investment but not expect the same performance for another year to come?
Yes, I would like to caution him that not to expect that performance, because it was very opportune. What has happened in the last 1.5 or 2 years, we have seen the big rupee depreciation, and we have seen the big US run up in the US market. But it is a worthwhile fund to have. It adds to the diversification. It is a meaningful diversification, and it's a high quality portfolio. A portfolio of globally competitive businesses packaged in this single fund.
All right, so hold on to that fund. He has a list of tax saver funds there. He might not need all of them. So I'm going to go through that list quickly. There's a Canara Robeco Equity Tax Saver. He has the Franklin India Tax Shield, Reliance Tax Saver, the ICICI Tax Plan, and the L&T Tax Advantage. Of all of these, would you like to skim that down and bring it down to maybe 1 or 2 funds? Does he need to have 5 tax savers?
He doesn't need all of this, because when I look at some funds, when I look at Canara Robeco Diversified Equity or a Franklin Tax Shield, it's a very conservative tax saving fund. The others can get aggressive or can assume risks, and which is worthwhile, because you get locked in for 3 years anyway, and particularly for him, he's investing for many years. He should not leave the opportunity of taking the tax break. If I have to choose 1 or 2 aggressive fund of his selection, I would say Reliance Tax Plan, Reliance Tax Saving Fund, and the ICICI Tax Plan.
All right, the Reliance Tax Saving Fund and the ICICI Tax Plan, 2 tax savers that you can continue. But of course, Anurab, you've done a fantastic job of picking your funds. Keep it simple, continue investing on a regular basis, and of course, we're always here to help you if you have any questions. Let's take one last question before we end this segment. Manikanda has written in, he's been making monthly investments of 15,000 rupees in HDFC Top 200, ICICI Prudential Focus Blue Chip Equity and L&T Equity. He now wants to increase his savings to 25,000 rupees every month. He wants to know if he should continue with these same funds. Should he add anything to these 3 funds? How would you like him to go forward?
No, I think it is time for him to do a complete review of his investment, and he should seriously look at our aggressive growth portfolio or growth portfolio, and which means that he will have to drop HDFC top 200 as well as ICICI Prudential focused blue chip.
All right, Dhirendra, thank you so much for spending time with us this week. It's always a pleasure to have you on the show. Now, if you have questions for Dhirendra Kumar, write to us. Email ID is at the bottom of your screen. Coming up after the break, we'll help someone with a salary of 20,000 rupees and credit card debt of 90,000 rupees. How do you tackle a problem like that? Don't go anywhere. Welcome back. You're watching Investors Guide in ET now. Thank you so much for joining us. Let me bring in Gaurav Mashruwala to answer some of your questions. Gaurav, we have a lot of questions that have come in from very young viewers this week, and we hope you can help them out. Our first question comes in from Huzaifa, who writes in saying he has a take-home salary of 20,000 rupees every month. He has no investments right now. He's only 25 years old, but he has credit card debt of 90,000 rupees. He wants to know where he should invest his money, and I don't see how he'll have any money to invest until he solves this credit card problem. Gaurav, is there a solution? Should he be using maybe a personal loan and just cut up his credit cards right now? How would you like him to solve this problem?
So in case of Huzaifa, I would first recommend to pay off credit card debt, because the rate at which they charge interest and his salary and outstanding amount on credit card, that's going to catch him. I mean, it's going to get him into a trap very soon. So first, plan out to pay off credit card outstanding, maybe on aggressive basis. Once that's cleared, then he should consider investment, and at that point of time start with contingency fund. Look at health insurance if he doesn't have one, then life insurance if he has dependents, and then based on his goals he can start an SIP if it's a near-term goal, either SIP into debt instruments or a recurring deposit, and if it's long-term goal like retirement or something, an equity fund, maybe a mid and small cap equity fund, because age is on his side, so he can look at higher risk. But his first aim is to get rid of credit card debt as soon as possible.
All right, so if you have a similar problem like Huzaifa, write to us on the email ID at the bottom of your screen. I would recommend that you stop using credit cards entirely if you have a tendency to let that pile up and not pay on time. Let's take another question. Pavan has written in, he's 28 years old. A monthly income of 80,000 rupees. He tells us he only has one investment, the IDBI insurance plan, and he pays a premium of 40,000 rupees a year. He's not really happy with that investment. Gaurav, what would you like him to do? If he's going to start a portfolio, he should start considering an emergency fund, insurance, and then look at investments. Give him a checklist on how he should do it.
In case of Pawan Kumar, one is that I don't know what kind of insurance policy he has, but it seems like a ULIP, and which is a income guzzler. So amount of money that he pays, he's going to end up paying huge amount of expenses. So he may want to relook at it, whether it's worthwhile to stop or continue or kind of surrender or make a paid up, but that's his call. But he should consider that first. Once that's taken care of, whatever other money he has, since he's young and he has not articulated his financial goals, there are two things that can be done. For near-term goals, so if there is marriage in the offing, or if there is house purchase or whatever, then he may want to choose debt instruments, do a recurring deposit in a bank, or do a debt-based mutual funds. If there are long-term goals like retirement, etc., which is more than a couple of decades in this case, he may want to start investing in an SIP of an equity fund. So there could be an equity fund which is an index fund or a large cap fund based on his skills and time. If there is something which is interim, which is likely to happen next 3 to 5, 6 years, you may want to create a portfolio which is a combination of debt and equity. So first, relook at your existing life insurance, take an optimal call on that, and then start considering investments.
All right, Gaurav, thank you so much for helping our viewers. And if you have a question, you're a young viewer watching at home, especially if you're a woman, write to us. Our email ID is on the screen, and we'll be always open to answering your questions on this show. You find a copy of the show on our Facebook page, and you can reach me personally on Twitter. I look forward to hearing from you. Thanks so much for watching.